Hey everyone, welcome back to the Weekend Charts. I'm your host, Charlie Bilello, and as always, I'm going to run through the most important charts and themes that we're seeing today in markets and investing. We have to start out with the performance of different asset classes through July. It's been a rising tide that has lifted all boats. And if we look at that 2023 column here, what we see is 100% of major asset classes with a positive return in the first 7 months of this year. So what a difference from last year. Last year at this point in time, we were talking about one of the worst starts to a year in history for the equity market, bond market, worst start ever. And this year, one of the best starts for the equity market, bond market, up a little bit, not as great as the equity market, but still up a few percent. But every major asset class, from equities to crypto to equities in the US, depending on market cap, we have large cap, small cap, mid cap, all positive. We have value stocks and growth stocks positive, preferred stocks, high yield bonds, investment grade bonds, REITs, everything in positive territory this year. And what we've seen is really the polar opposite of 2022 in terms of the leaders and laggards. So the leaders in 2022 were commodities and cash. Those are at the bottom end of the performance spectrum this year. And the laggards last year were things like crypto, so Bitcoin, NASDAQ 100, growth stocks, tech stocks, all did the worst last year, and they're doing the best so far in 2023. So if we look at the equity market in terms of countries, this is pretty interesting here. How many of you had Nigeria, Greece, and Argentina to be the three best countries in terms of return so far in 2023? Probably no one, if we're being honest. I certainly didn't, which just proves this kind of thing is impossible to predict which country is going to be a leader or lagger, why a portfolio with diversification really makes sense for most people, because we don't know who are going to be the leaders in the future. And you certainly wouldn't have predicted that those few countries would be leading things looking at their economies. So if we look at the US, though, S&P 500 on a total return basis up over 20% the first 7 months of the year. Very strong 7-month return. Still leading in terms of outperforming international in the top third of countries this year. So really that trend that has been going on for over a decade now of US outperformance has continued, at least so far in 2023. So what has investors most bullish, I think, about this year so far? It's not just the performance of the major indices, it's really the performance of the story stocks. So the technology stocks, particularly the biggest stocks in the market, if we look at Apple, Microsoft, Google, Amazon, Nvidia, all of these stocks having massive returns so far this year. A number of them, like Nvidia, Apple, and Microsoft, hitting new all-time highs this year. And then we have the overall S&P 500, only 1% away at the end of July on a total return basis from hitting a new high. So this kind of recovery, I think, has sentiment to levels we haven't seen since November 2021. We've been talking about that sentiment on the higher end of the spectrum. A lot more bulls today than there were a few months ago, certainly a lot more than there were last October when things were looking pretty bleak. So this type of rally has people excited. And it's not just the thing going on in the equity market that has people optimistic. It's the things that are going on in the economy. And I think number one would be, well, there's no recession through the first half of the year. And driving that is the continued strength in the labor market. So we have non-farm payrolls. The report that just came out showed 31 consecutive months now of positive payroll growth. And we had that unemployment rate moved down to 3.5%. And if we look at this chart here, a historical perspective, you can see that's very, very low. It's only a little bit above where we were in April, 3.4%. That was the lowest levels that we've seen since 1969. So very strong labor market, unemployment rate very low. And we're seeing that across a number of states. Half of the US states are at or near record lows in terms of the unemployment rate. So the jobs market, we talk about, it was crazy couple of years for the jobs market. You had a tremendous loss in jobs in March, April, May of 2020. And then we've had this just recovery since then clawing our way back. And we saw just these massive payroll gains following those losses. And now we're starting to moderate in terms of this rate of change. And that's why I say the labor market is slowly moving back to a more normal state here. We can see 2.2% increase in jobs over the last year. Well, that would be on the higher end of things, let's say pre-COVID, but certainly now entering a more normal range. Other signs of a return to normalcy, I would say, is the quits rate coming down. So these are people quitting their jobs voluntarily, and 2.4% is the lowest we've seen in some time. It hit a peak of 3%. So when there was just a enormous number of job openings out there and people were feeling good after getting the stimulus payment, well, they had more leeway in terms of being able to quit their job and look for a job that they like better. Today, that's less so the case, still high, but more normal range. And what we're seeing in terms of job openings, something similar, just off the peak, but still on the tighter side of things. So is payroll growth likely to continue, let's say, for the next month or two? I'd say very likely, because we still have so many more job openings than we have unemployed people in the country. And there's still many industries that need more workers. Not every industry, but certainly I think the demand for labor is still exceeding the supply. And I think that explains why we're still seeing hourly earnings increase at a higher than normal pace. So we're seeing 4.36% increase in hourly earnings over the last year, which is certainly above the average pre-COVID. And I think that's just a function of, obviously, one, inflation, and two, demand exceeding supply. So when more and more people come back to the labor force and those job openings come down, we should see this rate of earnings growth go down. So the good thing, though, about this chart is now hourly earnings are outpacing inflation. Hopefully that will continue. We have a 4.36% increase in hourly earnings. 3% was the inflation rate last month. And I think when we get the July data point, it'll be another month of positive real wage growth, but it's going to be less so than we saw last month. And so here's why I'm saying inflation is likely to rise when we get that July CPI print. And the reason is just math. Like the year-over-year inflation rate is a function of the last 12 monthly prints in terms of inflation. And so we've had 12 consecutive declines in that rate of change. And a big part of that was just a moderating in terms of the year-over-year growth rates. We were comparing to last June when we hit that peak. A lot of commodity prices declined in the back half of last year. We saw used car prices come down. So a lot of other factors slowing their rate of growth. And so we hit that 3% level in June. Everyone was excited about that. But in the short term here, it's not likely to continue to go down. The Cleveland Fed is predicting a jump up to 3.4% for July and 3.9% for August. Why are they thinking that it's going to go up? Well, I think it's simply because we're replacing the July and August numbers from last year, which were pretty low, especially for July. Last July, we saw a 0% increase in prices for the CPI. So that's going to fall off, and in its place is likely to be something higher. We don't know exactly what that's going to be, but let's say it's 0.3%. Well, that's going to drive up that overall inflation rate. So one of the big drivers, I think, of that is going to be the increase in commodity prices that we saw throughout July here. And you can see unleaded gasoline, crude oil now positive on the year, and just a pretty good surge higher. And this is the reversal of what we saw at this point last year. So at this point last year, we're coming down from these extremely high levels, especially if we look at gasoline prices. They peaked in June of last year and trended lower for a number of months after that. So the last few months, we've been comparing to those high prices from last year. That's been helping CPI. But as we get through July and into August here, we're seeing now the highest gas prices that we're seeing on the year, and that rate of change in terms of comparing to last year is narrowing. So let's say gas prices a few weeks from now remain at the current levels to the end of August into September. Well, now we're going to be seeing a positive year-over-year rate of change for gas prices, other commodities as well, likely to be in that category if you look at heat oil and crude oil. And so what was once a tailwind for CPI, bringing it down for 12 consecutive months here, is going to be, at least in the short run, a little bit of a headwind. So likely to see CPI rise. The market should be expecting it. The question, I guess, is how much is going to rise and how much of an impact that will have in terms of Fed policy. Is the Fed going to pause in September? That's what the market's currently expecting. But if these readings come in hotter than expected, and we start to push up against 4% CPI, perhaps that could change, and perhaps the Fed will feel like they need to hike again. So all of that remains to be seen. But in the short run, people should be expecting higher inflation rate, at least in July and perhaps in August as well. So talking about inflation, obviously still a concern, still out there. And what we have, not just because of inflation, but this was the initial driver of why bond yields were rising off of record lows. Everyone was talking about deflation in 2020. Bond yields hit record lows. Well, now all of a sudden, fast forward 3 years later, now we have the longest bond bear market in history. So what's driving that? Well, you can see here, these were the treasury yields at the end of 2020, just ridiculously low. You had 0% Fed policy in place, of course, but if we look at longer term yields, you had the 10-year below 1% at the end of 2020 and the 30-year at 1.65%. So just crazy low yields. And if we fast forward to today, you can see much higher yields, more than doubling of longer term yields. If we look at 30-year, 10-year yield has quadrupled in terms of percentage, and the percentage on the short end are just obviously massive, going from 0 to now a range of 525 to 550. So what a difference in terms of the bond market. And if you're a bond market investor today and you're looking at these yields, you should be excited. This should be a positive thing for you. And why is that? Because the single best predictor of future bond returns is that beginning yield. So where yields are today, we have a 10-year over 4%, we have short-term yields over 5%. Well, your expectation for the next 7 years for bonds should be in that 4 to 5% area. So that's the best predictor what we have of, bar none. It's over 90% correlation, one and the other, of future bond returns. And why have bond returns over the past few years been so bad? Well, that starting yield was just extremely low. So if we look at the summer of 2020, we're talking about a 10-year below 1%. And lo and behold, when interest rates rise, at least in the short run, bond prices fall. And what we've seen, if we look at the aggregate US bond market now, we have a 13% decline over the last 3 years. Just an incredible decline. And this is actually now the longest bond bear market in history by far. So you have 36 now months where bonds have been in a drawdown. We haven't seen that before in history. The Bloomberg ad goes back to 1976. We haven't seen anything close to that. So 3 years, and the reason for that is interest rates are very low and rising from very low levels, and you have this huge price decline. But if we look at the equity market, contrasting this with the bond market, the Dow last week on a total return basis recovered all of its losses from 2022, hit a new total return all-time high. So of course, investors feeling pretty good about that. We talked about the investor sentiment surrounding big tech and the huge rally there. The NASDAQ 100 up over 44%, best start to a year for the NASDAQ 100 ever through July. And so now you have this huge disparity between sentiment in stocks versus sentiment bonds. This is an index that goes back 24 years, and this is the highest Bloomberg said that they've ever seen in terms of the spread between equity sentiment and bond sentiment. So very bullish on stocks, bearish on bonds, and you could tell by the prices why that's the case. Stocks, if we look at the Dow, fully recovered, S&P not far off, and meanwhile bonds are still stuck in their longest bear market in history. So we'll come back to this and see if this is telling in terms of the next few months. Has sentiment in stocks gotten too bullish? We talked about active manager exposure, AAII poll, all of these things going above the 90th percentile in terms of showing some extreme over bullish sentiment. We'll see if that matters at all. But this is an interesting data point here where people are extremely bearish on bonds at a time where bond yields are actually the highest they've been. If if we're looking at short-term yields since 2001. So to me, that would mean you should be more bullish as a bond investor. Back here in 2020, you can see that bond sentiment was very high as compared to stock sentiment. Stock sentiment was very low, and you just had this situation where bond yields were at record lows. People should not have been so bullish as compared in the bond market. You had the stock market sell off during that initial stage in COVID, and bonds rally and yields hit record low. And so investors were doing the opposite of what they should have been doing. And not to say that the same thing's going to happen today, but it's certainly something to think about here. Why investors are so bullish on stocks versus bonds when you have a much higher return on bonds than we've seen in a long, long time. And we have the equity market going up significantly so far this year. And we'll talk about valuations and what that means for the equity market going forward. So Bank of Japan here, this is an interesting case study. The Bank of Japan is its own animal. They're the only central bank that's left that's still pursuing negative interest rate policy. The ECB abandoned it. Switzerland abandoned it. Everyone else has abandoned negative interest rate policy. Bank of Japan continues to say that it's necessary, despite the fact that they've gotten the inflation that they've wanted. They have an inflation rate above 3%. That's above kind of their target, but they're still saying negative interest rates are negative. But the more interesting thing here is in terms of longer term bond yields, where they were entirely controlling this area of the market as well, coming into the market buying 100% of new issuance in terms of JGBs, Japanese government bonds, driving yields into negative territory for some time. And in the past year, what we've seen is Japan kind of shift in terms of thinking. They don't see as willing to prevent yields from rising. There's been a lot of pressure saying they need to let yields start to rise. Perhaps they're starting to get a little bit more concerned in terms of the inflation there. But regardless, this is what happens when you let the free market at work. They a few weeks ago said we're going to let the long-term bond yield rise to as much as 1%, and immediately we saw a spike higher. So where this goes, I don't know, but it's an interesting case study to suggest that eventually, if you don't let the market do what the market's going to do, there's going to be a cost to that. And so perhaps the Bank of Japan is in the early stages of kind of shifting their thinking here, perhaps not. They've made it a point to say that, no, this isn't the end of easy money. This is just a transition here. And so don't take this as a signal that they're all of a sudden going to start tightening policy aggressively. But we don't know. They could change their mind on that point. I think the broader point is that this negative yield experiment that we've had across the world for all this period of time, if we look back on it, I think decades from now or even today, we could say that it was a failure in terms of its policy, in terms of what it was meant to do. And what it was meant to do is stimulate the economy, encourage more spending and borrowing. And we just didn't see that. We didn't see that in Europe. We didn't see that in Japan. And so perhaps here we're getting now to a more normal market environment. And interestingly, we talked about Japanese stocks being at their highest levels in decades a few weeks ago. And interestingly, this doesn't seem to be hurting the Japanese stock market. So you don't have to control the government, and central banks don't have to control the markets in order for corporations and for the country to do well. I think that notion that you have to keep interest rates at ultra easy levels in order for the economy to do well is a false one. And there are many hidden costs to doing that, and that will only be seen with the passage of time. So we'll continue to monitor. This is an interesting case study here. Last holdout in terms of negative yields. Still there, but on the long end, they've decided, the Bank of Japan, that they can't simply control it anymore. I guess they're unwilling to continue to increase the money supply and come in and buy all of those bonds to drive yields lower. So continue on the central bank note here. I think this is an interesting divergence that we're seeing between Europe and Latin America in terms of easing and tightening cycles. So last week we had Chile and Brazil cutting interest rates for the first time since 2020, and that's interesting. We expected that to happen. I talked about the reason why. That was because you have this spread between their central bank rate and the inflation rate that's positive. And if you look at a country like Brazil, highly positive. So they had room to cut rates. They've been seeing inflation on the decline, trending lower. And that was different than areas, let's say, like Europe if we look at the Eurozone and the United Kingdom, Bank of England, they still have more work to be done. So there's a divergence here. The UK hiked rates again, 525. They're expected to hike rates even more because they're still lower than the inflation rate in that country. Eurozone is as well. So we have a divergence setting up where the countries that hiked rates earliest, and if we look at Brazil and Chile and these other countries in emerging markets, they all lifted their interest rates well in advance of the US and Europe. And now they seem to be cutting rates in advance as well. So this could mark the beginning of a trend, I think, across Latin America. Mexico will likely be next if we look at the spread between their central bank rate and inflation rate over 6%. So they certainly have room to cut. And Europe just in a very different situation. If we look at the US, we have a central bank rate a few percent above the inflation rate. But the question is that inflation rate now going to start rising again? And does the Fed want to have more comfort in terms of that inflation rate coming down? So for now, the expectation is the Fed is on pause. Europe still has some hiking to do. And emerging markets, particularly in Latin America, perhaps are at the early stages of a cutting cycle. So interesting divergence there in central bank world. Let's talk about the rising cost of cars. And this is something to watch pretty closely because we've talked about monetary policy and its tendency to have a long lag in terms of its impact on the economy. And this would be something to look at in terms of the interest rate on new car loans continues to rise here. So putting more and more pressure every quarter that we get this data in terms of the consumer who's financing, for the most part, the new car purchase. So over 80% of new cars are financed. And now we have the interest rate 7.59%. This is on a 48-month loan. It's the highest we've seen since 2007. So what that means is, of course, for anyone financing the purchase of a car, that monthly payment's going to be much higher. And so you have two choices. Either you extend the term of the loan, which we're seeing a lot of people do. You take out a 60-month loan or 72-month loan to keep that payment down. So it's just going to take you longer to pay it back. Or you look for a cheaper car, or you just say, I'm going to put that off, or I'm going to have to, let's say, take on credit card debt or something else. So something has to give. What we've seen so far, and we talked about, is the demand side has come down in terms of the transactions are much lower, but the transactions that are going on at much higher prices. So average price of a new car this year, $46,000. That's $11,000 higher than where we were 3 years ago. So we were at $35,000 and change in 2020 and June of 2020. June of this year, $46,000. That's an enormous, obviously, increase in a 3-year period. Wages have not kept pace with that whatsoever over the past few years. And in addition to that, you have the fact that the cost of financing has gone up as well. So not similar to the housing market, it's not just the price that's gone up, it's the cost of financing as well. And if we look at the average monthly payment on new cars, you can see up and to the right. And this, I would suspect this will continue as long as rates continue to rise and as long as prices stay elevated. So very different picture for car buyers today versus a few years ago. You're just looking at a monthly payment here close to $750 a month on average for new cars. And we talked about a few months ago how the percentage of people that are spending $1,000 a month just on their car payment is increasing every single day. So I would think this at some point is going to put pressure on the economy. It's not just autos. We talked about housing. any area that requires credit and financing, these big major purchases have just become more and more expensive. And at some point, that has to hit demand and in turn will hit the economy. But there's a lag. So we're not seeing it just yet in terms of the overall data. The question is, are we going to start to see more of this in the next few months? So let's talk about the credit downgrade really briefly here. AAA Fitch downgraded to AA plus. Not a huge shock. They cited expected fiscal deterioration over the next 3 years. They also cited the high and growing general government debt burden. All the stuff we've been talking about, Fitch kind of touched on and saying the U.S. is no longer a AAA. Now, does it matter that Fitch is saying that? Not really. Nothing really changes fundamentally, but psychologically, will this have an impact in terms of the short term, in terms of markets? It could. We saw it in 2011. Market obviously recovered from that, but certainly sentiment could pick up on this and use it as a reason for a sell-off. We've talked about how much the market's gone up this year and how sentiment is on one side, so it wouldn't be surprising to me at all, at least, if this led to some type of pullback. But if we're talking about the big picture here, we're talking about that high and growing general debt burden. To me, that's a huge issue. Of course, it's an issue that's unaddressed. We have over $2 trillion deficit. We have the debt increasing just by an enormous amount in what's supposedly an economic expansion. And so you have this double whammy where the debt level is going up and interest rates are going up. And what that's leading to is higher interest rates as a percentage of GDP. And this chart here goes back to 1947, but you can see for a long time, interest payments as a percentage of GDP were pretty low. And the argument people made was, don't worry about the national debt. Interest rates are so low, we don't have to worry about it. It's just easy to make those payments, so we shouldn't worry about it. But that's changed dramatically in the last 5 quarters. It's gone from 2.4% of GDP to 3.6% of GDP and likely to continue to rise as we're seeing as the old debt rolls off with low interest rates and new debt is issued at higher interest rates. So as long as we're talking about 10-year above 4% and the shorter term maturities well above 5% now, all of that old debt is rolling off and new debt is being issued at much higher interest rates. And this is going to put more and more stress in terms of being able to service that debt, is the fact that interest payments are fast approaching $1 trillion on an annual basis. So a higher and higher share of the budget is going to go to that interest expense. Well, that creates a problem if you don't cut other areas. So either the government has to borrow more to make those interest payments, or if they have to cut somewhere else. And so far, they're certainly not cutting from elsewhere. So they've just been borrowing more, which compounds the problem as interest rates continue to rise. So no shocker at Fitch, I think, did this downgrade. Now we have 9 countries left in terms of AAA ratings across the 3 major rating agencies: Germany, Denmark, Netherlands, Sweden, Norway, Switzerland, Luxembourg, Singapore, and Australia. And if we look at the bond yields in these countries, all lower than the US. So certainly the market is in agreement in terms of, you could view, one way of viewing the risk of a market is to, in terms of the credit, is to look at the yield. And for now, US 10-year treasury yield is higher than any of these countries. So we'll see if Moody's follows suit at some point and drops the AAA rating. But again, there's no fear that the U.S. is going to default. The U.S. is going to make their payments. You don't have to worry about that. They could always just borrow more money or print money to pay that money back. So the U.S. is never going to default. But I think this is an accurate reflection in terms of this debt burden is going. If it's left unresolved, it's going in the wrong direction in terms of the trajectory, in terms of the deficit and the interest payments continuing to rise. So perhaps this will get the attention of Congress, but I think that's wishful thinking for the time being. Deficit continues to increase, and so does the debt. And as long as interest payments remain elevated, that's going to become interest rates remain elevated, it's become an increasing share of the budget. So let's shift gears here, talk about the housing market and this interesting relationship between new home prices and existing home prices. So naturally, you probably expect, if we're looking at the median home price, you'd expect there to be a premium for a new home, right? You'd much rather buy a new home than existing home, all else equal. It's obviously it's newer, it's nicer, it's less likely to need a repair. For all those reasons, you expect new homes to have a higher selling price than existing homes. But an interesting thing is happening here in the past year, where we've seen a convergence where new home prices have come down and existing home prices remain elevated. So that spread between the median new home price and median existing home price is now only $5,000. That's the lowest we've seen since 2005. And there's a couple of reasons why I think this is going on. Number one would be the builders. They're offering more incentives. So if you built a home, you want to sell that home and you've seen affordability collapse, well, you have to incentivize the buyer. So you're lowering the price point. Number two, this is an important one here. There's been a shift in the past year where smaller homes are being built at lower price points. So another way to combat that affordability problem is, instead of building that 4-bedroom house, you're building a 3-bedroom house, less square footage, that costs less to build that home, and those are selling at a much better rate than more expensive homes. So it's a shift in the mix in terms of what is actually for sale. Number three would be simply the supply and demand dynamics, where we've talked about how the existing home market has the lowest supply it's ever seen. And the big reason for that is people aren't selling because they're locked into these low mortgage rates. Well, the new home sales as a percentage of the overall market is around 30%. That's the highest that we've ever seen. And so if you want to buy a home, there's more supply of new homes relative to existing homes, relative to the historical averages. So relatively speaking, the higher rate of supply in terms of the new homes is causing a lower average sale price point. So we'll see if this continues, or even if this crosses over, which is an interesting dynamic where the market is kind of solving or trying to solve this unaffordability issue with the existing home market, where people are simply saying they're not selling, they're not moving, so there's no supply, and that's keeping prices elevated. The market's trying to solve that in the new home market by lowering prices, incentivizing people to buy smaller houses that are more affordable based on their income and based on the fact that interest rates on 30-year mortgages are now above 7%. So a lot of this is going to be dependent on where mortgage rates go and home prices go, but just a fascinating thing to see this spread kind of narrow here and what's driving that. So I want to talk about earnings season here, and what we've seen is better than expected growth for sure in terms of revenue growth or earnings per share growth. You can see all of almost all of the big companies showed a positive year-over-year revenue growth number, and almost all positive in terms of earnings per share growth. I think Apple, in terms of the revenue number, would be surprising to a lot of people given its performance this year. It actually had negative revenue over the last year. It's the third consecutive negative quarter, but for the most part, pretty strong earnings, definitely better than expected. And the question is, what has that done to the multiple? Well, if the share prices were up in similar magnitude to this revenue growth or earnings growth, well, you would see no change in that multiple. But what we've actually seen this year is an increase in multiples, and that's because these share prices are up so much this year. They're up way more than the revenue or earnings growth number. So we're seeing still pretty elevated, I would say, price to earnings ratios across big tech and the market as a whole. This is trailing 12-month, and price to sales ratio as well, still elevated versus, let's say, the last 10-year average or so. And what we're seeing across the NASDAQ 100 here, I think tells an important story. It's been a big multiple expansion from where we were last October at the low. So 4.2 is the average, the median price to sales ratio of a NASDAQ 100 company last October. Now we're at 5.9. That's the highest since April 2022. Still well off where we were at the peak here in late 2021, but certainly much higher than where we were last October. And what's driving that is simply sentiment, the sentiment bullishness around earnings, around AI, the potential for that for all of these big tech companies, all of these NASDAQ 100 companies is driving expectations up and multiples up. Now, does this tell you anything about where the market's going to go over the next year? Absolutely not. You can see it can go higher, it can go lower. But I think it's very interesting and important to note here that we're now above the average from the last 10 years. And at the same time, you have interest rates well above the average from the last 10 years. So now, instead of having 0% rates that we had throughout most of this period over here, we have a short-term yield over 5%. Instead of having a 10-year less than 1% that we saw in 2020, we have a 10-year above 4%. So very interesting to see that despite the change in dynamics in the bond market and what you can receive in terms of the risk-free rate, that people are still bidding up these shares to these types of multiples. So we'll see in the next year or two if this changes, has any impact, but it doesn't tell you anything in the short run. But I'd say in the long run, the optimism surrounding big tech is back. And historically, when you have this high level of optimism, what you tend to see is lower returns, let's say, going forward. So just keep in mind, if we go back to that first chart talking about the rising tide, NASDAQ 100, and I said this a few weeks ago, but I'll say it again, up 44% in 7 months is not normal. That is certainly well outside the range of what we've seen historically, and investors should be cautious when everyone's getting excited and greedy about that. That doesn't mean it can't go up, but do not expect anywhere near that level of change. And if we look at valuations, you can see that expectations are not low anymore. They're not lower than they were in 2020. That's what we saw in last October. They're now on the higher end of the range, not as exuberant as what we saw in 2021, late 2021, early 2022, but certainly above average. And that doesn't mean anything in the short run, but in the long run, I would be more cautious as an investor. I want to end with something positive, as we always do, and that is the fact that cash is no longer trash, and the 3-month Treasury bill yield 5.55%. That's the highest we've seen since January 2001. So if you have money sitting in your bank account earning 0%, I'll say it again, fight that inertia. Go out there. You can get a higher yield by either buying treasuries directly. You can get a high yield savings account, any number of things, but there's no excuse. For years, it didn't really matter. You're earning 0 on these short-term treasury bills, but now you can actually earn something. And interestingly here, and importantly, you can actually earn well above the rate of expected inflation. So this is looking at the 3-month treasury bill yield minus the 10-year break-even inflation rate. You can see here, highest levels that we've seen in the last 20 years. So you're above 3%. In terms of your real expected yield, in terms of where cash yields are today. Now, this may not last, but it's certainly a much better position if you're holding cash than what we had for a long time, where we had negative real yields, where yields were not keeping pace with inflation. That's simply, if you're holding rates at 0%, which the Fed was doing, inflation even at 2%, well, now you're losing 2% in terms of your purchasing power every single year on that. And now, finally, we have the opposite scenario where you're being paid on your cash. So what is this doing to money market fund assets? Well, of course, money market fund assets are exploding higher. There's good reason for that. People are taking their deposits out of banks that are earning nothing, putting them in money market funds. And so we're seeing now a record 5.5 trillion in terms of money market funds. Don't see how this would slow down as long as rates remain high, as long as bank deposit rates aren't competitive with money market funds. So ending here with this slide here, very easy to go out and find rates now above 5%. Many online savings banks that are FDIC insured, you can get above 5%. So again, no excuse to be sitting there. Most money market funds, one of the biggest ones, obviously from Vanguard, 5.25%. So if you have a brokerage account, well, now you're getting a higher yield on your cash. So very good news for investors who have short-term needs where they can't be invested long-term. So you're going to be buying a house in the next year, going to be buying a car in the next few months, or you have that emergency savings, a few months where if anything were to happen, you want to have that cash on hand. Well, now you can very simply get 5% return on that. And that's great news for, I think, everyone. Hopefully it stays there. We don't know. But for now, pretty good. Best return on cash that we've seen since 2001. So with that, we'll end it there. Have a great rest of the week, everyone. And if you like the channel, as always, subscribe to the channel for more content just like this. And I'll see you next time on the Week in Charts. Thanks.